Good afternoon. This is Robert Rayburn here at Life Pro Asset Management. It is November 18th of 2024. I hope everyone had a great weekend, and I'm certainly glad everyone could join us. I know it's been a couple of weeks since we've had one of these updates. Been out of town for work, a little bit of travel requirements. So I do apologize for the delay on these updates. Now, the good news is things have been absolutely fantastic since we have not been recording. So if that's if there's any correlation to that, perhaps we should not be recording every week as usual. That said, we will get back to all kidding aside, we will get back to our weekly recordings. But I do want to thank everyone for the patience there. As we've seen over the last couple of weeks, we've had a very, very large positive repricing across our growth portfolios. Those small mid-cap growth stocks in particular have benefited quite a bit from the clarity of the election simply ending. Now, is there an element there within that growth trade that was a little bit more geared toward Trump versus Harris? Of course, absolutely. Obviously, crypto in particular and fintech, those are some of the two primary beneficiaries of financial deregulation. Now, whether that plays out or not remains to be seen. We do think there's some confidence in that because the administration that will be coming in is very pro deregulation, and you don't necessarily need to have 60 votes in the Senate. You don't need to have a House majority, even though they have it, to pass a certain type of bill. Deregulation lies at the executive power. So the executive branch can execute a lot of those deregulation actions, but that's not really what we want to get into this week. What we do want to understand is that we've had this post-election rally. Now, that last week, we had a little bit of a pullback. And is this part of a potential fizzling out of the rally as the excitement over the election settles down? Or will those gains hold? That's what we're going to go through this week. So 3 big things. What are the state of the markets post-election? How long can that Trump euphoria last? And what do credit markets think of the Trump win? Or what do the credit markets think of the interest rate pop that we've seen since the election? We're going to go through all of that. So let's go ahead and get started. I wanted to bring this slide back up, and I've used it in the past. And it's a great lesson of not constructing portfolios based on what we see in the news or in the headlines. And I know I talk about this a lot, but the election was just a great example of this. People selling and buying protection ahead of the election, even though protection was richly priced, right? So in other words, life insurance is always going to be more highly priced if there's something wrong with you, right? And what people saw was this obvious conclusion that something bad was going to happen on election day, so they bid up portfolio protection. And sure enough, what we had mentioned, this is the exact slide that we had used a few weeks prior to the election, was this idea of sell the rumor and buy the news. Would you want to buy the market going right into election day? And our thesis on this was that the VIX structure has suggested that election fear may be very well baked into the price of the market, and that's exactly what happened. So the election happens. Guess what? Didn't matter who would win. We just knew who was going to be in power, right? The only negative outcome could possibly be that if you didn't know who won. But given the election, the strong results, in other words, there was no question as to who won, gave markets clarity. Markets can move up so long as they know the rules. So again, when we look at what's been happening since then, volatility has come down. Prices have gone up. And we largely think that this will stay course for the time being. Now, we have a bit of a bipolar market. So the first couple of weeks, what we saw was, hey, Trump will deregulate and cut taxes. Buy stocks, right? Then last week, we saw, well, hey, lower taxes and higher spending will lead to higher rates. Sell stocks. This can be a whipsaw effect as it relates to the psyche of the average investor. And the psyche of the average investor attempts to try and gain clarity or as to around which narrative is correct, which thesis is correct. Is Trump good for stocks because he's going to deregulate and cut taxes? Or are lower tax and higher spending going to lead to massive deficits? And those massive deficits are going to send interest rates higher and the market's going to crash. Our answer is we don't care about narratives, right? We try to be active followers of the market. And we try to measure the symptoms of the market to give us clues as to where prices may go. So how do we make sense of that noise? Well, for us, it's instead of trying to guess which narrative may be correct, let the market express itself and then measure those symptoms and try to figure out where we should put the money. Because once markets turn, they don't turn for a day. They tend to turn with some longevity. There's a certain stickiness when markets start to turn one way or the other. And so we like to be what we call active followers, right? We have no issue calling ourselves active followers of the market, right? Because we measure the symptoms and we simply say, okay, based on the symptoms that we're seeing, what is that? Is there continuity to this price action? And that's how we look at things. So what are bonds trying to tell us right now? So we look at the headlines. Interest rates have shot higher since the election. S&P 500 has gone up, right? But like if you look at the headlines, Trump victory sparks debt worries. U.S. bond market braces for Trump trade of large tariffs and deficits. Trump plans could increase U.S. debt while raising costs for most Americans. Most Americans expect Trump to increase debt. Yada, yada, yada. Panic in the headlines. And we've seen interest rates move higher, right? Now, what's interesting is that despite that, corporate spreads, so in the bond market, the spread of corporate bonds to US treasuries has gone down. So even though you have these panicked headlines, the cost of borrowing for companies has been moving lower and the S&P 500 has been moving up. So this is a great example of, over here on the left, narrative versus symptom, right? The symptom, what the market is trying to tell us and express itself is that, hey, credit markets are saying that there's nothing wrong. S&P 500 saying, hey, I'm taking my cue from the bond market that there's no systemic risk, risk on, bid prices higher. I don't care about what this news editor had to say and approve for the front page of the newspaper. That doesn't mean anything. This means something. So why are yields potentially rising? If it's not this, because if it was this, the S&P 500 or credit spreads wouldn't be doing what they're doing. So why are they moving higher? Well, another thing's been happening over the last month, which may more effectively explain the action. Economic surprises continue to move to the upside. And what happens when growth picks up? Well, when growth picks up, interest rates tend to move up. Why? Well, because interest rates tend to be correlated with economic growth because they tend to reflate prices. It's a function of demand. So the media says yields are going up over fear of deficits, but markets are saying that rising yields may be a function of higher economic growth, which would explain the higher stock prices. So, okay, let's dig into that then. If that's true, we would expect economically sensitive stocks to be outperforming recession-proof stocks. So let's look at what's happening. Well, we had this chop in small caps, chop, 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 chop. And then guess what this is? The election. Whoosh, you had this huge move higher in small caps. Now you've had a dip on this concern over the deficits. Well, what is it really? Well, it's really just an oversold condition within a broader market rally. So rising economic surprises, higher potential growth, and that higher growth tends to be positive for cyclical stocks. And that's what you've seen here. And now, even though you've had a little bit of dip in the last couple of days here, about a 5% retracement for small cap stocks, we're now in oversold territory, even though we remain above the breakout that we've seen over the last month. So consolidation, massive breakout on the election. We got overbought, then we retraced. Now we're oversold within a broader market rally. That's the message. Then when we look at the S&P 500, we say, okay, where are the net relative new highs? So what are the areas of the market that are making new highs versus making new lows? Interesting picture painting. Industrials, communications, financials and banks, energy, technology. What's not? REITs, utilities, consumer staples. These recession-proof areas of the market are making relative new lows versus the S&P 500 making relative new highs. Cyclicals relative to defensives have not pulled back at all. Look at this massive breakout with no pullback. Again, a function, the market is trying to tell us something. Headlines, newspaper narratives, human judgment saying Trump is bad for deficits and will lead to a crisis in the bond market. Interest rates move up. Oh, interest rates must be moving up because of that. Versus actually, economic surprises moving up, potential growth moving up, interest rates following that juncture, and we see it in the market. Small caps outperforming large caps. Tech, industrials, banks outperforming recession-proof sectors. These are the narratives that we follow. We follow the symptoms, active followers of the market. And then we look at Bitcoin, the ultimate risk on trade, consolidation, strong breakout. And what's interesting is, remember, we actually used this slide. This is an old slide. The only thing I changed here was the chart itself. The chart itself is different. The title and the words are the same. And what we had said before the election is that as polls have reversed in favor of Trump, Bitcoin has been acting much better. Spurious correlation, or does someone know something? So was Bitcoin giving us a potential clue as to what was happening in the election? We think so, right? That shadow money that sniffed out that something was there in the election, that the polls were not actually that close. So the bottom line, ladies and gentlemen, is we want to focus on price and symptoms. The markets gave us a clue about the election. Look at how the markets were behaving 1 to 2 months ahead of that election, and then how they followed right after it. Keep paying attention to those clues. Fintech, Bitcoin, crypto in general, software, mid-cap, small-cap growth. They continue to act with resilience. We even saw that on a pretty rough day on Friday. So what we want to look at, we want to pay attention to those clues. And at some point, we're going to have to do a good job of paying attention to clues when things suggest that prices may move the other way. Number 2, interest rates shot higher, but that's the narrative. Higher, bad, deficits, Trump evil, right? Versus the reality of credit spreads are shrinking. So in other words, corporate perceived credit risk is shrinking. And then cyclical assets outperforming defensive assets. Again, not a recession type of symptom. Remember all those people, the world is going to end a day after the election. If this is what the world looks like when it's ending, I'm fine with the world ending then. So again, we want to fight narratives in the media, and we want to pay attention to what the market is trying to tell us. Pay attention to the message, pay attention to the price, pay attention to the symptoms. That's what we got for you this week, 888-543-3776. Have a wonderful week, and please call us if you have any questions whatsoever. Thanks again.